June was a month where debt markets remained influenced by global uncertainty, particularly US Iran developments and their impact on crude oil prices. Elevated energy prices kept inflation concerns in focus, while currency pressures and global rate expectations continued to influence investor sentiment. As we move into July, key variables such as inflation trends, central bank outlook, and global developments will be critical in shaping the direction of debt markets. To help us understand what this means for debt markets in July, we are joined by Mr. Abhishek Bisen, Head Fixed Income at Kotak Mahindra Asset Management Company Limited. Welcome, sir.
Thank you.
So, debt markets remained volatile, however, yields trended lower, right? How do you read the overall setup as we enter July?
The overall situation has become very encouraging as far as fixed income is concerned, especially post monetary policy, where RBI decided not to take monetary measures to address the currency and inflation issues. They decided to take non monetary measures, such as action on the FCNR front, which will probably bring in potentially around 50 to $75 billion worth of flows, which has helped the bond markets, and effectively the yields have started trending lower.
So, US Iran development led to sharp fall in Brent crude, right? Please tell us how crucial is crude for inflation and debt markets right now?
It has been the most critical part of the overall story because once the war broke, crude almost shot up from 65, $70 a barrel to almost $120 a barrel, which was as good as 100% jump, right? So, which disturbed the external front, as well as if you pass through to the customers, it would have disturbed the internal, such as inflation. So both accounts, it started disturbing the overall macroeconomic stability. So given the developments on the US-Iran deal, crude oil prices has started easing and have come to a level where it is in a reasonably comfortable zone. This will not only help the external account as well as the internal account, which was not at all factored in the prices. Markets were conservative, pricing in that this situation is likely to continue for a reasonably long period of time, which would have deteriorated our macroeconomic stability, and therefore we would have ended up in a fairly high interest rate environment for a foreseeable future.
So, monsoon led inflation concerns remain a risk, right? How should investors read inflation outlook from here on?
Well, that is again a critical question because we still have estimates. We don't have anything on hand. Monsoon has been a disturbing factor. Uh, every day we keep getting newer developments. Things are started becoming better. However, till the time we are midway or probably over it, we won't be able to say what has been the impact of monsoon-related impact on inflation in terms of prices. But this government has levers to make sure that they are able to soften the impact of monsoon-related impact. But till the time we see, we won't be able to comment, and that is going to remain a risk because we don't know what is the magnitude. It may not happen at all because we have irrigation facilities are much better. Things can be much better than what we are estimating as if now. So it is some time to go, but yes, it is in a near month and a half. The picture will be much more clearer in terms of sowing and in terms of harvest. What can we expect from the monsoon?
Now, talking about RBI, it has stayed largely in a wait and watch mode, right? Do you see any change in the policy stance going forward?
Uh, yes, in terms of stance getting changed, we don't see the risk of stance getting changed, which was getting factored in, let's say, a 15 days back. However, in a recent interview, the governor clearly mentioned that had we would have wanting to prepare the markets for a rate hike, we would have changed the stance. Now, given this statement, if we read it 2 plus 2, I don't think so. that stance changes anywhere in the mind of the central bank, especially in a scenario when crude oil prices have corrected to pre-war era, almost pre-war era. Monsoon-related risks are there, but probably it is receding given some development on the monsoon front. So the risk is not as high as it could have been. Therefore, it is fairly okay, and we don't foresee anytime soon stance change or a rate hike kind of scenario will emerge in the Indian space.
So yields have started trending lower. Do you see it sustaining? And what could be the triggers for the next move in rates?
So, as we discussed, yields have started trending lower because markets had started to factoring in significant amount of monetary tightening possible because of the crude oil prices and possible outcome of relatively a weaker monsoon. So, crude oil prices issue is more or less settled for now. Monsoon related risk we don't know. However, things are much better than what it was 15 days back. So both of these account things are fairly okay. In terms of markets were discounting significant tightening, that is unlikely to happen. And on the other hand, Bloomberg index inclusion, the inclusion of Indian government bonds in the Bloomberg index is a likely trigger which can happen anytime soon. If that happens, that is likely to bring in around 20 to 25 billion dollars worth of flows. That is likely to be a straight demand for mid to long term bonds in the Indian government space, which could further trigger yields much lower, and the spreads which had widened are likely to compress, thereby generating risk adjusted superior return for the duration investor.
Now, we also know that global rate expectations and central bank actions remain key, right? What are the other global factors that debt investors should closely track?
Crude oil prices have been one of the key factors which we had to watch because that disturbs everyone. Given that factor has already been settled, other factor is the Fed, whether the Fed is likely to hike rates or not, since inflation related issues have are much lower. Uh, the possibility of Fed raising rates, while it was discounted that the next move could be a hike, that probably can get postponed. So we need to wait and watch this equation uh, much closely, because if things change in the global space, this equation can change very quickly. Therefore, while we are out of the woods, but uh, volatility can be the order of the day for some time.
Now, in this environment, positioning also becomes critical, right? Please suggest how should investors approach debt allocation in this environment?
Well, that has been a standard rule, and investors should match their investment horizon with the underlying durations of fund. However, since understand this, markets have been discounting monetary tightening much more than what is likely to get delivered. Therefore, across the curve, there will be reasonable amount of gain, which will be in proportion to the duration which you are holding. Therefore, you can choose your fund with your risk appetite and investment horizon. That has been the advice which we've been giving to the investors. However, it is clearly favoring for some duration appetite from the investor front.
Thank you so much, sir, for joining us and sharing your insights on the evolving debt market scenario.
Thank you so much.
We hope this discussion helps investors navigate the current environment with greater clarity and perspective. Stay tuned with Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.